And a big welcome to our live audience for Digital Health Investor Talk. I'm your host, Stephen Wardell. I'm the managing partner of Wardell Advisors, a digital health advisory firm, and the author of The Future of Digital Health. Wardell Advisors is helping digital health companies address issues around growth, fundraising, trade sales, and strategic alternatives, giving you more options in today's challenging environment. You can follow me at x.com/Stephen Wardell. Our show today is on the topic of the return of the solution aggregators. In the space of digital health benefits, solution aggregators are emerging as purchasers who are looking for an enterprise buy. Today's guest is Michael Pace. Michael is the founder of Boston-based Palm Health Co., a health tech market access and commercialization consulting firm. He's the former head of market access and value evidence at Pear Therapeutics and was earlier the head of global value strategy, pricing, and market access at the consulting firm Icon PLC. You can follow him at linkedin.com, Michael Pace-DTX. This show is being recorded and will be included in my podcast series called The Digital Health Investor Talk Show. Subscribe to our podcast on Apple and Spotify and leave us a review. We always love getting reviews. We have a new podcast links for the show, so when you find the show, make sure you're seeing a recently updated show link page and not one that was last updated a few months ago. This show is not investment advice, and we are not investment advisors. Here's the format of today's show. It'll be 90 minutes, and Mike and I will spend the first half discussing the news and the macro picture and other topics, and then the second half we'll focus on the topic of the day. And we'll take your questions throughout in the LinkedIn comments chat. Mike, welcome to the show, and please introduce yourself.
Hey, thanks, Steve. Great to be back with you again. My name is Mike Pace, as you mentioned, founder of a small boutique consulting firm where every day we try to make market access and commercialization of health technology feel a little bit more like the day at the beach, which is kind of apropos given the fact that we're past Memorial Day and it is the summer season. And as we'll discuss, health technology commercialization is not a terrible amount easier than it used to be, nor is adoption, monetization, distribution, enrollment, engagement, and all the other aspects of health technology work necessarily as easy as we might like it to be. So that's the nature of our work. I'm Boston-based, as you mentioned, and in the course of my work supporting commercialization and market access of health tech, and I mean health tech in all sorts, molecular, digital, and otherwise, person, non-person, synchronous, non-synchronous, monitoring and or treatment in the entire spectrum of that on a global basis. We're rolling up 30 plus years of biopharmaceutical and digital health experience and the trials, tribulations, successes, and failures along the way into trying to bring some wisdom, a little bit of wisdom, maybe like you do, Steve, to your clients in a fashion that's kind of fit for purpose and personalized. So thanks for having us back.
We got some feedback from the audience that your audio is a little low volume, and so I see you got a headset. Maybe you could hold the microphone closer to your mouth with the headset. So let's see. Our first topic is macro news, and we cover some of the macro news that the innovation economy, that's young company leaders and the investors who back them, should hear about. In macro news, I'll just cover that we're still living in a world where the Fed Chairman Jerome Powell has said we should expect inflation to be higher for longer, and so therefore rates will be higher longer, and that's bad news for the innovation economy, unfortunately. Now, that suggests that the current high level of rates, such as the risk-free rate being about 5.5%, will keep going for longer. It doesn't suggest that rates will rise further. That's good news. Rates probably won't rise further, but we were hoping for 3 rate cuts by the end of the year, and that may push out those 3 rate cuts that we're hoping for by the end of the year. The innovation economy would love to see further rate cuts. So, Mike, any thoughts about? Do you follow the Fed and inflation and interest rates and that sort of thing? Any thoughts on where we are and what we might see by the end of the year?
hard not to follow it, right? Particularly when our client base is looking for some degree of of funding, and investors in our client base are looking for some degree of certainty and expectation, and it's all over the board. So I am not I have no crystal ball on Fed activity, but we all know that we would hope for a bit more certainty, and certainly rate cuts would be embraced by our community.
Great. And then, so, last I checked, the market indices are at record highs. So the NASDAQ is at around 16.9 thousand. That means it's up 69% in the last 18 months. I think none of us predicted that the NASDAQ would be up 69% in 18 months ago. That's quite a run. In order to be considered to be a stock market genius, all you would have had to have done 18 months ago is put your money in the NASDAQ. And that's in general good news. So the NASDAQ is a proxy for growth stocks and innovation. That's good news for the innovation economy, young companies. It means that they should start, that investors like their sector, and they should start seeing some investors looking to invest in private growth companies as well, which in order to see some of that rise as well. So that's good news that the NASDAQ is at record highs and continues to go up. And then other news, we just had earnings season, and an intriguing thing came out of earnings season, which was that two of the sort of the bellwethers on software and SaaS, Salesforce and Dell, saw major hits to their valuations. So I think Salesforce had and Dell had small misses, and this led to their stocks pulling in by very large amounts. And this is interesting because these have been darlings of Wall Street for 10 plus years. And I think this is you're seeing Wall Street have some concerns about the valuations of SaaS companies. And what happens in B2B SaaS often comes and visits us in digital health as well. And so the first thing that they're seeing is that these software companies sell to the big enterprises of America. And those big enterprises are belt tightening. They are hammering vendors like Salesforce on price. They are cutting the number of seats that they're subscribing to from Salesforce, et cetera. And that has obviously has a negative effect on Salesforce's revenue and earnings. But the second is there's just a concern that it's now easier and less expensive to develop software. And so nimble competitors are going to duplicate what Salesforce and Dell have to offer to businesses and jump in and cut the price. So the price of the whole value stack of SaaS selling to B2B could collapse. And so this is interesting for a couple of reasons. One is that the same thing could happen in digital health. You could see a nimble company come along and go after incumbents like Cerner or Epic or Medidata or Viva or others. Another reason is that SaaS valuations are an important benchmark in digital health. We look to SaaS valuations of B2B companies, and so if Salesforce and Dell are pulling in, that's concerning about future valuations of digital health companies. Mike, any thoughts about the stock market being at record highs and also this little earthquake in the world of B2B SaaS?
A ton, because I think the divide of winners and losers is as wide as it's ever been. Like the sum total, the net of winners and losers is we're up, right? You said the NASDAQ's up. By the way, the Dow's up 2%, New York's NYSE's up 7%, NASDAQ's up 14%, FTSE's up 6%. Everyone's up. We're all happy as a clam. We're fat and happy, loving our 401ks. Everything's doing great. We're only 5 months into the year, and we've already made 18 months worth of upside, right? In a normal year. But the winners and losers are dramatic, and they're dramatic across the healthcare sector in enormous ways. As an example, let's look at EMR. Epic is taking Cerner's share left and right? Oracle buys Cerner. Cerner's getting crushed. Epic's winning big. But guess what? In the market, Oracle's up 15% year to date. They're doing really well. But on the EMR and the health tech side, they're getting crushed by Epic, which is kind of interesting. Of course, we all know the story of NVIDIA, and of course, we all tell each other at the bars that we got into NVIDIA at $2 a share, right? Aren't we really cool? We knew it like long in advance, and that wasn't really me, so I'd be lying. But the winners and losers in health tech have been astonishing me all year long, and I didn't pick them all right. But who would have thought that Amwell and Teladoc will be down 71 and 50% year to date, respectively? 71 and 50% year to date, respectively, in telemedicine and telehealth. And then on the other hand, we have like some comeback kids, like Talkspace is up over 10%. They nearly were on the brink of going out of business after their SPAC. Hims and Hers is up also 11%, which has been great news. And look at the pharmacy-led, drug-led type of digital health companies like GoodRx up 43% year to date. And then when I think about just those digital health startups, I think about who their customers are. And I think about the winners and the losers in the healthcare delivery and in the insurance and in the consumer-led healthcare market. As an example, how about the pharmacies? Walgreens and CVS are down 40% and 26% year to date. That's amazing. These are that 20, 30, 50, $70 billion companies. On the other hand, you have a Best Buy and a Walmart that are both up 24%. Two different reasons. You have a Best Buy diving into remote patient monitoring in a big way, leveraging the Geek Squad. We probably all know who the Geek Squad was, and maybe we bought a LED television from Best Buy. But they're diving in big. But what did Walmart just do? It exited. They had a big plan to do, right, delivery in rural clinics, and just said, no, we're not doing that anymore, along with some others as well. But they're doing very well. And the same holds true, Steve, as you know, in the health insurance space. And Medicaid and Medicare that used to be the big profit centers in 2023, really getting hurt this year. It's really substantial headwinds on the Medicaid side with redetermination. So Humana and Centene down 22% and 7% year to date. We all know United's issues with Change Healthcare and some massive issues there, but there's a lot of strength. So there's a real divide, a significant divide. Like no one sits at plus or minus 2%. Everyone sits at plus or minus 10% or above.
Yeah, very interesting. And by the way, we got some comments. And anything you can do to sort of boost microphone value, like hold the mic near your the headset mic near your face would be good. Thank you. That's a really good summary. And I think I agree that there's never been a bigger divide between winners and losers, and we're seeing so much innovation, so much trying of new things and seeing what works. And then we had a pandemic and then raising of rates, and now we're kind of seeing who has really figured out how to contribute value, and that's being recognized in stock prices now. Well, moving on to our next section is industry reports. So I didn't see any reports worth calling to our audience's attention the last week or two. Mike, did you see any?
I don't know that I would say the last. I think I got some echo there for a moment, Steve. I don't know that I would say anything in the last week or two. Obviously, the first quarter digital health funding reports are more than a month old now. We've all seen those. But given the nature of our conversation today, I just wanted to call our audience's attention to just the plethora of fantastic reports that many of the broker consultants, the aggregators themselves, have put out as it relates to employee benefits, cost and trends, and the like. So great reports out of Mercer, out of WTW, out of Virgin Pulse, and out of a whole bunch more, National Business Group on Health. So a number of really important kind of trend reports that I encourage everyone to take advantage of the fantastic research that the ecosystem is doing to try to drive better value in healthcare and try to meet needs in a more precise way. So I wouldn't call out anyone in particular, but I just encourage sourcing that material.
Thanks. And for our audience, any macro news stories you want us to comment on, or industry reports that you saw that you want to call out with the finding of it in our comments, please do so. So then on to our next section, which is trade journal news and business news in general. And it's still a time of more wind downs than fundraisers in digital health. It's still a time where there's not a lot of great news for digital health out there. But I try to pick out what is the biggest story in healthcare of the week. And I'm having trouble the last week or two picking the biggest story. I think it could be the hacks of hospitals might be, and how vulnerable hospital workflows are to being hacked. Everything has to go in the EMR and then come back out of the EMR for hospitals to do their work. And so what happens when your EMR gets hacked and shut down? And it also, of course, is a threat to patients' privacy as well. Mike, any thoughts on what the biggest story of the week is?
Goodness. We're at Tuesday, right? I still have a hangover from last week, just in the in the Trump trial. To be honest with you, I know we're talking about digital health, but holy mackerel, we have a lot going on in the world. As it relates to digital health, I mean, I'm just optimistic. I'm happy to see people talking about Waystar IPO, and happy to hear more chatter about Sword and Hinge and others. I'm excited to think that we might see a little bit of bursting of the balloon here, and perhaps the opportunity to learn and to drag off of this. So I don't. Beyond that, I'm just excited with a little bit of the momentum and not necessarily the singular story itself that I would suggest is the big news.
And so now getting into some trade journal news, I like to look at fundraisers and acquisitions and what we can learn from them. One story was Plenful. This is a workflow automation company in pharmacy. I had not heard of them before, but they announced that they had raised $17 million in a Series A from TQ Ventures and Sousa Ventures. Those are not the mainstream, historic digital health funds. This is part of a pattern we're seeing of young companies successfully raising, but oftentimes their syndicate does not look like a classic syndicate with the mainstream top digital health funds that we would have seen 3 or 4 years ago. So let's see, Joy Liu is the CEO there. And workflow automation in pharmacy, that's a classic area where software can add a lot of value. And where payers are often willing to pay in that area. I thought that was an interesting fundraise. Then virtual therapeutics. So here is a digital therapeutics company. I was not very familiar with them, and they have acquired Accolade. And so I'm glad that Accolade was acquired, but it was sad to see what happened to Accolade over the years. They had a high potential video game for ADHD for kids, and then the company was SPAC'd, and then the stock price fell, and they've struggled since then, and they encountered a lot of the classic problems of prescription digital therapeutics, which was problems being prescribed by prescribers, used by patients, and reimbursed by payers. So I hadn't heard that much of virtual therapeutics before, but it's a company in Washington state that was founded by gaming executives. So here's gamers coming into the world of therapy, and their website shows products in areas like meditation and then stress management and that sort of thing. So I noted that they were bought by Virtual Therapeutics for 43 cents per share, and I went back and looked, and their high when they went public was $14 a share. So that's quite a climb down in share values. Mike, any thoughts on Plenful and the acquisition of Accolade?
Absolutely. I mean, the acquisition of Accolade is something that I think that our community has followed Accolade, and rightly so, for a large number of years. Right? If we look back at the early founding of the company, it really was at least the most high profile video game based therapeutic organization in the world. It was very early and very well funded, with a tremendous team, put in place to carry this thing forward. Accolade produced the fifth prescription digital therapeutic authorized by the Food and Drug Administration. It was authorized in mid-COVID, June of 2020. And it, like other PDT companies, including my alumnus organization, Paratherapeutics, struggled in exactly the way that you said, for lots of reasons beyond what is generally publicly known as well. But I think that, and this is not a surprise, right? It was 1 month from the time that Accolade publicly announced its seeking strategic alternatives as a business. It was only 9 months removed from the point in time that it decided to deprioritize its prescription digital therapeutics journey and to invest in exploring a consumer unregulated adult application, so a version of its EndeavorRx product focused on adults specifically, unregulated. And it explored that over a couple quarters. It produced early metrics that were interesting. They doubled down on that, but didn't actually generate kind of margins, revenues, adoption of significance that would certainly kind of give everyone generally confidence in the ability to go it alone and be able to do what they needed to do with the limited runway that they had. They also had significant debt on the balance sheet as well, which the audience might know. They, as opposed to others, paid off. One of the reasons Pear went bankrupt was essentially a margin call, a debt call by Perceptive Advisors after that deal had been renegotiated a couple times, and he didn't have the money in the bank. Accolade had the cash in the bank, paid off its debt, sought strategic options, and found an acquirer. I guess, Steve, at a $34 million transaction value, but they had $50 million on the balance sheet at the time of the announcement of the transaction. So you and other financial experts, more than me, will probably have lots of things to say about how that goes. I think what's important here, or at least what I hope will be the case, is I hope that the premise, I hope that the patients, I hope that the premise of what Accolade built will live on and will be expanded upon in significant ways by virtual therapeutics or by its evolution over time. And that's obviously too soon to tell on anything here, as virtual therapeutics has no real public presence or track record. And really kind of the only thing that generally is known in the public is that they had significant funding by United Health Group at one point in time that has been reportedly changed most recently. So there are many unanswered questions yet. But we hope that the fourth approved prescription digital therapeutic will live on to be able to benefit children with ADHD and their parents and caregivers.
Thanks. Ed calls out that Pelago raised a $58 million Series C. Yes, very interesting to see that. So San Francisco-based Pelago, which is a behavioral health, an enterprise-focused behavioral health company, raised the money. And I'm looking here, very unusually, the round is led by European funds. So Atomico, a London-based fund, Kinnevik, a Swedish fund that often invests in digital health, Octopus Ventures, one of the top digital health funds in London, were the main investors. Once again, you have a leading U.S. digital health company, in this case Pelago, going outside the usual syndicates of leading mainstream U.S. digital health investors in order to raise money, because those investors are sitting on their hands on the bleachers, not investing, not jumping in the pool. So you wouldn't have seen this 3 years ago, but Pelago going to London to raise its next round. And then we also had, Lewis points out, Sword Health raising $100 million with a 50% step up in valuation. That's great news as well. So I'll just call out SamaCare, a specialty medication workflow platform, raised $17 million in an oversubscribed Series B with Questa Capital. They're a leading digital health investor, South Park Commons, and Vive Collective. So here's not that many fundraisers in the last 2 weeks, and here's the first one that has a kind of a mainstream U.S. Investor syndicate behind it. Siam Palakirthi is the founder and CEO of Samacare. Mike, any thoughts on the companies I just named, or any other discussion about what's going on in digital therapeutics?
Yeah, for sure. Pelago, obviously, rebranding of that organization, multi kind of substance abuse treatment organization, utilizing a variety of digital first and human oriented activities for both, for nicotine, for opioid use disorder, for substance use disorder. And as it relates to the conversation we'll have later, Pelago has utilized the aggregators as a part of their go-to-market and commercialization strategy. They've been an early participant in Evernorth Express Scripts digital health formulary. They participate alongside another PBM navigator in Rightway. So they certainly are participating in the aggregator reseller distribution navigation economy. So that's what I would say about the organizations that you had mentioned. But related to digital therapeutics specifically and what's new there in funding, today we just saw an announcement on a Series A add-on from Accina Health. And Accina Health is a kind of a reorganized organization that came out about a year plus ago, working in the women's health and the incontinence and other kind of pelvic disease disorder areas. And their product Leva is quite interesting, and they've had a very narrowly but successful journey thus far, and have achieved some substantial payer coverage in the U.S. And in fact, some prominent Blues plans are covering this prescription digital therapeutic, and this was the fourth. Steve, this is the fourth in the market, fourth product ever approved by the Food and Drug Administration. And I can tell you that I believe that it is the first product ever to be covered by a large national health insurer for its fully insured book. Cigna covers Leva itself. So there's some interesting things there, and it was heartening to see a prescription digital therapeutics company being invested in and announced today, because what we've seen over the past 3 months and over really unfortunately the past year is bankruptcy and bad news as it relates to prescription digital therapeutics. But this is the exact reverse. This is an organization that is being invested in, that has shown some traction and ability here, and just announced today. So I think that's bullish for this segment of the market. By the way, it also, we can connect the dots there and speak about the fact that Click Therapeutics, now considered maybe one of the leaders, at least in privately backed prescription digital therapeutics segment, went ahead and picked up the assets of Better Therapeutics subsequent to its closing of its doors. So on the one hand, we might see the IPO market stymied a little bit by sentiment, by uncertainty, by funding flows, by interest rates. On the other hand, we're not seeing transactions just be silent at all. We're seeing substantial mergers and acquisition activities besides early stage venture funding, and in fact, even potentially the IPO. I'm bullish.
That's great. I think people were just very concerned to see a couple high-profile things happen with Pear and Better and Accolade, and you're pointing to actually, a lot of the approvals and fundraisers and acquisitions that are moving the sector forward. So that's great.
There are policy things as well, Steve. I might just add for 10 seconds here. So one of the things that maybe is not as well recognized, but is starting to get some more substantial airtime, is some of the policy and guidances that are coming out of the Food and Drug Administration that are very, very, very inclusive and very appealing to drug device combinations, software as a medical device companion application, and frankly, moving towards a future state where drug labeling itself and potentially, not unproven, But patent protection could in fact be enhanced through the combination of software as medicine technology in combination with molecular health technology as well. So this PDURS guidance, or PDURS is the acronym from the Food and Drug Administration. We're going to hear more and more and more about, and more biopharmaceutical companies and others, and digital health startups, I think, are starting to tune into the fact that this idea of drug digital combo is more than just an idea, but it's IP, it's long-term value creation, it's differentiation, it is claims different and beyond. So something to watch out for, I think, Steve.
Great. So now in our agenda, skipping down a bit, we'll go to upcoming conferences. So in this area, we talk about conferences that are coming up, our view of them, whether we're going to them, that sort of thing. And for our audience, if you have any conferences you want to ask about, feel free to ask about them in the chat. Coming up, starting tomorrow in Boston, is the Digital Healthcare Innovation Summit, which is an investor and partnering conference in Boston, Wednesday and Thursday. And so I actually have a discount code for this conference for my audience. It's DHIS Social 1524, DHIS Social 1524. I'll put this in the chat. And so this is the best East Coast investor conference in digital health of the year. And it's one of the best ones other than JP Morgan and the health conference in October in Las Vegas. So I recommend this conference. It's a little short notice to get there now, but investors go to this conference, good representation from Boston and New York investors, and you can, it's both for education and also meetings with venture investors, and also with partnering executives from incumbents in the industry. So I like this conference for that reason. And then after that, AHIP is coming up. So AHIP is June 11th to 13th in Las Vegas. AHIP is a great conference that brings together the general managers of health plans once a year, and it's a conference that has an expo floor and educational panels. And so for this conference, if I were a vendor selling software into the health plans, I would definitely want to go to this conference. I'd want to expo at the conference. And it's still a conference where you can meet health plan managers and people in the office of the health plan manager over lunch in the hallway. It's not too big. It's not too over prospected. So I like AHIP as a conference. And then with that, I'll say, Mike, any reaction to Digital Healthcare Innovation Summit in Boston and AHIP in Las Vegas, June 11 to 13?
Well, I know you'll be staying in Boston for the prior. And AHIP next week, I'm a big fan of, and have been to the annual meeting at AHIP back when they weren't called AHIP. Right here would know that a bit. It is a great conference, but it's one, again, for any of your audience that's never attended it, or maybe has attended it once and struggled in that environment. It requires a lot of planning up front. It really requires a significant kind of commitment to make the most out of it. I found it to actually be, number one, I mean, I think it's a relatively good, significant size. It's not small. I mean, it's not HLTH, right? It's not 15,000 people. But on the one hand, it's manageable, but on the other hand, it's one that a warm conversation, a lead, a prior connection, a scheduled meeting would be very, very helpful. Otherwise, you're trying to meet speakers standing in line after a speaker event. Certainly, there are displays that are worthwhile, and I certainly encourage the consideration of potentially displaying, depending on your stage and what your product is as well. But great conferences. So if you're not going next week, consider it another week. And for me, I won't see you in Boston at the conference you're going to, Steve. I'm going to DC tomorrow morning because one conference that your audience might want to consider in the future, if they can't make it to DC tomorrow through Friday or already scheduled for the other meeting. The Digital Therapeutics Alliance has begun a summit meeting in DC. And this is the second year that they have put together this summit meeting. And it's a very, very intimate, well-attended meeting, very much focused on networking, content, advocacy building. And in fact, many members of the Digital Therapeutics Alliance and partners have been on Capitol Hill today, in fact, lobbying for certain digital health access initiatives and coding reimbursement, coverage payment initiatives as well. And I participated in that last year. So I encourage your audience to check out the Digital Therapeutics Alliance and consider their summit, whether or not maybe the Alliance will continue to just do it once a year in this June timeframe. I don't know if they will think about doing it differently, but it's a great event, great venue. Several hundred, senior level folks from all parts of the industry, CMS, AMA, later, you name it. It's a very, very diverse audience, and of course, founders, CEOs, and otherwise.
That's great. And also for our audience, so someone has called out the Behavioral Health Tech 2024 conference. That's Uri. Thanks for calling that out. And I'll also throw in that for the first time ever, the health conference, which I like in October in Las Vegas, and which I consider to be an investor conference. It has very good attendance nationally of digital health investors at that conference, is for the first time doing a conference in Europe, in Amsterdam, June 17th to 20th. So for this conference, it's their first year. I would take a wait and see approach to this. So if I had a European client and they said, should I go to Health Europe in Amsterdam, June 17th to 20th, I would say, well, as far as I know, it's better to go to, typically a European digital health company wants to sell and raise money in the US. And so I'd say, go to Health in October in Las Vegas, and let's wait and see whether it's worth going to Health in Europe in Amsterdam. So I would take a wait and see approach to what this Health Europe conference turns into. Mike, any thoughts on that?
Yeah, no experience there. So it depends on your point of view. HLTH itself, right, in the US, it's huge, and you got to do your homework there too, to not just spend your money and be really tired, but to turn it into something super productive. I would assume that the same would hold true in Europe, except that it doesn't have the track record. So there's a bit of an unknown there.
And Edward in our audience has a question, I think, for you, Mike, which is, what do we think about some of the momentum around MHSUD parity regulations?
Mental health parity regulations? Yeah. I'm assuming that's what's meant.
Mental health, substance use disorder parity regulations. It's an area I'm not very familiar with.
So maybe just a quick comment there. Maybe the biggest name in mental health parity was kind of the driving advocate, Senator Kennedy from Rhode Island, when he was the senator from Rhode Island. Many might recognize Senator Kennedy's battle with substance use disorder, and he and colleagues were responsible for bringing the Mental Health Parity Act through Congress and into law. Over time, it's been interesting, and certainly during my time at Paratherapeutics, this was in our mind all day long. And it certainly is in the mind of people like Steve, you mentioned earlier, Pelago, and dozens and dozens of other very reputable organizations that are trying very, very hard to mitigate the scourge of substance addictions. And in that context, unfortunately, one of the things that we face from payers in our healthcare system, I call it the office of no, right? And this fundamental incentive to deny and to not be fair and to do the types of things that for-profit entities would do to drive their bottom line, but that we might not view as being fair, ethical, in total alignment with the law, or some other things, right? They might not be outright illegal. And we've seen this, right? We've seen United, for instance, get hammered on using AI for prior authorization denials, right, over the past month. This is not uncommon. This happens all the time, right? And it's happened for decades. Our insurance organizations just trying to manage their business in the best way that they can, so they will be as aggressive as they possibly can be. The Mental Health Parity Act was to try to level the playing field. It was to try to say, wait a second, mental health is as important as physical health, and therefore um, mental health benefits and mental health access to mental health needs to be equitable to access to physical health, and benefits should be on kind of an even playing field. And this should be across the board. It doesn't matter as an American where you sit from a benefits perspective. So it's a high profile thing that I hope gets more and more airtime. I personally believe that there's been plenty of skirting of kind of that requirement, so to speak. But I do hope that we'll see advocates, legislators, health plan executives, health technology developers, coalesce around something that is right from a health equity and a mental health.
Thank you. And thanks, Edward, for that question. So moving on to our next section is personal notices. So this is where Mike and I get to tell you things we're doing where you'd be welcome to join us. And the first actually is that on next week, Thursday, June 13th, I'm hosting a party for Mike in downtown Boston. So this is our Boston Health Innovation Night, and Mike's going to be there talking about digital therapeutics and the solution aggregators again. And this is so we hope you can join us there. You have to register at Eventbrite. You can go to stephenwardell.eventbrite.com to get a ticket to come to our Boston Health Innovation Night with Michael Palm next week, Thursday, June 13th. And then also I'm leading a fitness walk for the Boston Health Innovation community on Saturday, June 22nd. You can also find that one. There's no fee for that at stephenwardell.eventbrite.com. And I'll be at the Digital Healthcare Innovation Summit Wednesday and Thursday of this week in Boston. Mike, any public personal notices or availabilities?
I don't want to take up all of our time. I'll see you next Thursday in Boston at the Liberty Hotel and look forward to that. I'm going to enjoy the summer, work on client work, and I've got a lot of things going on in the fall. We don't need to talk about that now, but yeah, those are my notices.
That's great. So now we'll dive into the main topic of the show, and for our audience, feel free to ask questions in the comments. I guess why don't we just start out with this table of the solution aggregators? Can you tell us more about it? I see companies here that sell into the employer health tech market. I see CVS, Evernorth, and Walgreens on this list. The list keeps growing. So what was the origin of this? And you call it the solution aggregators because some of these companies have marketplaces where point solution companies make available their point solution to be sold through the solution aggregator to the buyer, who may be an employer. Tell us more about this chart and the sections of it and how it's evolved.
Yeah, happy to do that, Steve. Fundamentally, where this all came from is curiosity, really intellectual curiosity on the one hand, and on the other hand, client diligence, right? And this is really about understanding the landscape of as all of your audience knows and listeners today know, of an extraordinarily complex, heterogeneous, really crowded, very noisy, increasing tension market of well-intentioned organizations of a variety of different backgrounds. And it's funny, it would be like looking at a large family. It's like the Brady Bunch, right? And where did all these kids come from, and how did they grow into being the Brady Bunch? And when I look at even just the few dozen, because there are more, this is not fully inclusive. It is not fully historic. We've seen several mergers and acquisitions amongst this group. We have seen rebrandings. I used the words Virgin Pulse earlier in our conversation, Steve. As you know, that's not even like a real word anymore, right? The brand is Personify Health, subsequent to the Virgin Pulse Health Comp coming together. So we're learning, right? These things have evolved. the digital health formulary of Evernorth started as the digital health formulary of Express Scripts, the nation's second largest PBM. But now all of the largest of our healthcare organizations in America, United, Cigna, and Aetna, have developed, and of course Anthem, not no longer Anthem, but Elevance, have developed massive healthcare services organization outside of their own fundamental insurance membership. That's on the one hand. Then you have, on the other hand, you have a whole bunch of these organizations that have their roots in one domain of healthcare and have grown into either a different or obviously multiple extensions of other types of healthcare, really leaning into the problem at hand, leaning into the client need, and evolving their business to serve that purpose. So this for me has just been a personal journey of aggregating information on the aggregators to try to make sense of what's occurring in the market on the one hand in terms of let's call them, we could call them resellers, we could call them distributors, right? We could call them navigators, we could call them a variety of different things. But the bottom line is these organizations, as part of what they do for whatever kind of fundamental purpose, they have engaged digital health solution providers in some form or fashion. And they have decided that they are going to engage multiple ones for some reason, in some way, to serve a purpose for their well-being and for value creation with their clients. But they all came from different places. And examples are, some of them started as telemedicine providers. Some of them started as fundamental pharmacy benefit managers, right? Some of them started as care navigators. Some of them like have one foot in both of those buckets, like their businesses, like a Right Way, for instance, is kind of 50-50 on both sides. Take Amazon. I even put Amazon Health into the chart. Why is Amazon Health into the chart? Well, because digital health leaders saw Amazon Health as an opportunity area to cultivate new membership and enrollment. So they saw the data and digital capabilities of finding eligible members, engaging eligible members, and built that relationship. So I think that's essentially the genesis of where this chart has kind of come from. That's taken on a little bit of a life of its own, but it's been a ton of fun.
That's great. Now, why do some of these companies, I'll just name some of them, like a Quantum Health, Collective Health, Solera, Apri Health, which is the new name of Castlight, Accolade, Personify Health, which is the new name of Virgin Pulse. Why do you think they decided to create these marketplaces and be aggregators? Was it that buyers wanted a suite, or they wanted an integrated solution? Or they wanted validation. They wanted, Quantum to tell them that this was a great mental health solution that they're reselling. Why do you think that the solution aggregators chose to bundle these underlying point solutions?
I think if you were to speak to executives from each one of the 5 firms that you mentioned, I think that you'd find them to repeat back to you about 80% of the same thing and 20% of something different, which the 20% of something different might be the secret sauce that any one of these organizations might suggest that they bring to bear. I mean, I kind of simplify it to 2 reasons. One is client need, and 2 is their own opportunity to create value. So let's be clear. No one's doing this for free, right? So none of the aforementioned organizations that you spoke about are just doing this on behalf of generating eyeballs or getting a new client to do something different. We're doing it for a revenue generation and profit and value creation purpose, right? So many of these arrangements, most of these arrangements have some degree of fairly substantial revenue sharing as a part of the relationship. They all may differ in and they do differ in many ways. But I kind of oversimplify this and say, because I'm a lifelong pharmaceutical distribution and market access professional, I look at this very much like the way the pharmaceutical industry has played with the pharmacy benefit management industry for the past 35 years. It is as much a gatekeeper as it is a reseller, a distributor, an intermediary of sorts. We could describe it however it is, but let's look. There's a cover charge, and there is an access vehicle of which there aren't any guarantees for a digital health company, just like there aren't any guarantees for a pharmaceutical company that has their drug on a PBM formulary. There are no guarantees for a digital health startup that being a part of any one of these aggregators ecosystems, no matter how they're described, it doesn't rain money or value creation. It is an opportunity.
Edward comments, one throat to choke. Yes, Edward, I agree with that. So the idea there is that there's issues around integration and renewal of contracts. The employer, for example, may want to just have one vendor that is selling 10 of its own products and has a marketplace offering 30 other products. And then when there's a problem, they can go to that one vendor and say, fix this problem. And if they were doing the systems integration themselves and had 40 vendors themselves, then they would run into people pointing fingers at each other and no one they can go to say, fix this problem. Edward, that's a really good point. I would throw in here as well, as someone who, I've looked at maps of the industry for a long time, and we were always thinking that the consolidators would buy the targets. We were thinking that the bigger companies like a Teladoc or a Quantum or a Collective or an Accolade, some of them are public, would buy the point solutions to fill out their suites. And instead, they formed marketplaces and hosted 20, 30 companies. And I think partly that had to do with the low interest rate environment, that those young, small companies, they didn't have to give up their dream of growing big themselves. They could always raise another round at a high valuation. And then the consolidators would look at this and say, well, I can't buy that company for 20 times forward revenue. It won't be accretive to me. And so they were in this standoff where the young, small companies held out for very high valuations, and the big consolidators wouldn't buy them for those valuations. And so instead, they decided to resell, to create marketplaces and allow them to resell so that they could get to a suite, which is what the buyer wanted. And Jordan asks, what obligation do you think an aggregator should have to disclose fees received from vendors of the digital health product that are included in their aggregator? Mike, just any reflection on that we're seeing a marketplace instead of acquisitions is my thesis. And also, any thoughts on Jordan asking about disclosure obligations?
Yeah, great point on the disclosure obligations, because this has been decades-long discussion in the PBM industry, and one of the primary drivers of the coming into being of transparent PBMs. Steve, I think I just saw that you are going to have your next digital health talk with Capital RX, which is one of those, like Lividity, like a Right Way, like some others, right? So this whole group of up-and-coming PBMs. And let's not forget Mark Cuban. I mean, I'm a Boston guy. I'm really excited for the Celtics Mavericks final series here starting on Thursday. But look at Cuban messing things up with drug pricing, right? And because it's a lack of transparency, let's not forget this is ubiquitous across the entire healthcare system, right? Doctors don't have their pricing. Doctors don't have any price to quality ratio hanging on the front door of their PC. I am Dr. Wardell. Here's how much I cost, and here's the quality of my care. Shouldn't you have that, Dr. Wardell? I think so, but we don't, right? And the sign is not on the wall of hospitals either, and it's not on the wall of digital health companies or PBMs or insurance companies, anyone. But the PBMs have been collecting administrative fees from pharma companies who have been raising drug prices for decades. And the PBMs have become some of the most valuable businesses in America on the back of drug price increases. increases because they've taken a percentage of fees in a non-transparent way and never passed them through, right, to consumers and to health plans. And therefore, all the executives get pulled to Capitol Hill to talk about this. And AJ and the rest of the other pioneers in transparent PBMs build that business. So back to the question. Will this come to be? I would absolutely expect that stakeholders, if they aren't already doing it and lawyers aren't already asking for it and people aren't going to do it, absolutely predict that that will happen in this space too. Is it really required yet? No, but I would think that there will become a significant call for transparency amongst plan sponsors, clients, and aggregators in some form or fashion. And that will be just based on not just transaction fees, but outcomes-based fees, revenue share-based fees, and other types of fees for sure. Because we're very much sitting in the same domain, right? We're thinking of digital health solutions rather than molecular solutions with a middle person. And that is in no way meant to diminish the tremendous value that I think the dozens of folks that we're following here. And by the way, I think the PBM industry also adds tremendous value. It just so happens that the nature of the way business has been done has allowed them to arbitrage. And when you can arbitrage, people arbitrage. And until someone says you can't arbitrage anymore, you continue to arbitrage. It's human nature.
So Frederick makes the point that for the most expensive disease conditions, you need a nurse case manager who owns the member patient and takes them through their care. Frederick, I think I would agree with you there. And what we have is a far cry from that. What we have is employers are unhappy with the care that's provided by the official healthcare system for, say, back pain and diabetes. And so they offer their own solutions that often don't involve doctors for back pain and diabetes. And that now you've got the traditional medical system and you've got the care management, the digital health care management solution offered by the employer that's meant to keep them away from the traditional healthcare system. And I think you're right for the most expensive disease conditions. It would make sense to have a nurse care coordinator who can see the whole picture and can direct the patient to the next step in care. And we don't have that kind of a system now. We have a sick care system on the traditional healthcare side, and then we have care management solutions that don't involve doctors on the employer side. So let's see. Did you spot, when looking at this chart, talking about Quantum Health, Collective Health, Solera, Castlight, Accolade, Virgin Pulse, etc., did you spot any kind of emerging pattern of suite that they're offering? Like, what are the more important categories of products? Are they all converging on being the same kind of company? And what are the more important categories of solutions that they have? How would you segment the solutions they offer?
Yeah, it's another great question, Steve. They've all come from very, very different angles. So I'll give you. Let me give you several different pathologies and genesises here. So I would suggest that the PBM-led or the pharmacy-led solution offerings, for instance, from CVS Health and from what was ESI, now Evernorth Digital Health Formulary as an example. The solution set that's currently in place, a couple things. One, it hasn't changed in a long time. So it's really static. Both of them have been static, honestly, for almost 2 years, like really extraordinarily static. You ask me why that is, I would say because fundamentally it was built based on employer requests. It was just fundamentally the employers, this is what they used. This was really administrative offload of contracting. Beat them up for better pricing, manage my contracts for me, take advantage of, just offload the administrative lift for me because you're already my client for my pharmacy benefit. And by the way, we like these people and they do good stuff. And we would just appreciate it if you could take that off my plate. For the most part, that's not 100% of why things are there. But I think it's a large part of that. So they came into being and they've been very static since then. But then there's a whole other set of these aggregators, Steve, that are really dynamic, enormously active, really dynamic and coming at it from different areas. Many of them will say that what's driving them are high cost condition areas, are high demand areas for digital health solutions, are employer interest areas. All of those things are right. But some organizations take a preferential point of view. They try to do a regression from the mean and pit digital health competitors against one another for best pricing. They try to have preferred tiers of relationships, et cetera. Others have a very different point of view, and they say, come one, come all. You're right. Our job is to match the right solutions in the right areas for members. Not every solution is going to fit a member. A good example of that is a high profile report, first ever report that came out of Peterson Health Technology Institute, which is attempting to become the de facto health technology assessment entity in America for digital health solutions. Whether they get there or not, it's too soon to tell, and much is not yet said or done. But they've released one report. It was on the digital diabetes solutions, and it received a tremendous amount of feedback from the marketplace. But one of the things that it did say, one of its conclusions was one digital health solution, Vertas, even though they evaluated, forgetting if it was 7 or 9 now, remote patient monitoring solutions, et cetera, Fluco, Amada, Livongo, you name it. But they get to the end of the report and they say the only one that's worth a grain of salt in some areas is Verta. Everything else is really not worth a grain of salt for the most part. But then they say, now that said, even though it's worth a grain of salt, it's probably not going to be able to be complied with or utilized by a very large proportion of the members. Steve, you might be able to comply with that highly restrictive keto diet, but Mike, not going to happen. So you and I are both employees of the same company. Verta might work for you, but it ain't going to work for me. And to me, that's an example of some organizations saying, I just am not going to try to be the arbiter of the best. What I'm going to be is inclusive to options, and I'm going to try to member match, and I'm going to try to use technology, preference, AI, clinical acuity, et cetera. I'm going to use all of these personal preferences and really make it personal. So I think those are the way things have come together. And then the final comment that I make is, yes, on an overall condition area, there's no question that there's a common theme to some just high profile condition areas, right? To weight management being like number one, of course. We nearly have $1 trillion drug company now in Lilly, right? And Novo. So weight management, number one, cardiometabolic, mental health, cancer care, right up there, musculoskeletal, digestive health. Women's health, the hottest area of all, right? Infertility benefits rising in a big way, menopause up and coming, et cetera. Women's health, very big. But yes, everyone kind of coalescing generally around those areas, and then some working in the margins. One final comment I'd make is there are new aggregators in the market that have taken a completely different direction. A recent one that I announced in April, who just came out, Beanstalk Benefits, literally has an ecosystem that looks nothing like anyone else's, because in fact they're taking the path less traveled. Like, it's all the things that no one else is offering is kind of what they're offering and sitting on top of it, which I thought was a unique approach.
Yeah, thank you. When I look at especially the ones that sell to employers, there's this huge synergy of selling to the same buyer. So if you sell a diabetes solution to the employers, it's the same buyer as if you sell a hypertension solution to the employers. It's the employer benefit leader. So with the companies, with the digital health benefits companies that sell to employers, I've seen the following categories emerge over time. There is wellness programs that's like a step count program, for example. Then there's care management. That's programs for diabetes, hypertension, other obesity, and other metabolic and musculoskeletal, cancer symptom management, some others. Then there's telehealth. That's like Teladoc and American Well. Then there's mental health, behavioral health. There's enrollment. There's consumer-directed benefits. That's like HSA, FSA, HRA. and there's some other areas. And so a company that sells one of these into the benefit leader can sell any of these into the benefit leader. And so I think that you're going to see consolidation around that synergy of the sales force that sells into the benefit leader. And they're going to, and then within that, I think that strategically, there's two really important areas. And the first is care management. That's, again, this is like Livongo, now part of Teladoc, and Omada. They're in care management. And that's diabetes, hypertension, other metabolic, musculoskeletal, and other areas. I think you'll see a suite form around those. And that is the most important because it's the biggest. That's where all the cost is. That's where the potential to promise to bend medical trend down for employers lives in the care management sector because it's the biggest, most expensive people and conditions. And then the other important area is navigation. So navigation, that's like Quantum Health and Transcarent and Castlight, which was bought by Apri and Accolade. And navigation is not as big as care management in terms of the price of products and the potential cost savings. But it's strategic because it steers employee members toward one service or another. It steers them toward high-value physician networks. It steers them toward doing a diabetes self-management program before getting an expensive drug or procedure in diabetes. So those are some of the growing areas I see. And the two strategic ones to me seem to be navigation, like quantum. And notice that Transcarent, led by Glenn Tolman, has gotten into navigation. So it can tell employers, buy us and we'll help steer your employees toward high value care. Quantum, Accolade, and then care management. So those are the strategically most important sectors. And so I would expect these contenders like a Solera, Virgin Pulse, Collective Health, and others, if they're not in those sectors already, I'd expect them to get into those sectors because when they sell to employers, they need to be able to tell them, we helped you with navigation, steering your employees toward high-value care, and we helped you with the most expensive part of your health benefits, which is those conditions like diabetes, hypertension, musculoskeletal pain, that sort of thing. So, any thoughts on the sector consolidating with those areas becoming the more important parts for the consolidators to own?
Yeah, I think your premise is well supported for a lot of reasons. We haven't seen enormous amounts yet of consolidation, but I do agree that we'll probably see some more action in that area. Much like there was this thesis, you thought the point solutions might be bought up by some of the aggregators, and we haven't seen a lot of that. We have seen some of the aggregators white label build their own products. By the way, we've also seen downstream payers build their own products. United's a great example having a variety of digital health solutions that they've internally built, et cetera. But back to your point, I totally agree with you. So benefit maximization, there's a tremendous gap in kind of benefit value, right? In utilization, like the enrollment gap, the engagement gap, the next best action gap. There's enormous gaps in what could be maximized henceforth. Navigation, to the extent we ingest and do good things with data, and we can get people to take the next step and incentivize them in the right way and do these types of things, very valuable, right? Going to get at the root cause of we're investing in bringing benefits that people aren't using, aren't aware of, or aren't using in the right way, or when, et cetera. Very, very important. And care management is the short-term thing, right? All benefits leaders, all insurance companies are looking for 12 to 18 to 24 month ROI. Everyone's looking for short term. So of course, care management, right? Avoid the bad stuff, right? Avoid the expensive stuff, avoid all that stuff. So totally agree with you. I don't know when we're going to see the transactions and how they're going to come together, Steve. Like, we see Personify, we see Apri, we see these things coming together. We see the evolution of the insurance company, healthcare services organizations. So to me, I think of Optum, right? And I think of Evernorth, and I say, okay, this is the services enterprise inside of those really big companies. But these aggregators are wanting to really accomplish the same thing, except be able to deploy that and plug and play that anywhere in any population, right? Because Optum could deploy that in United Healthcare all day long, right? Any book of business, right? But everyone else wants to be able to deploy that capability everywhere to any client, custom API, done, ingest data, do it, go. Um, but that's exactly what I'm seeing happening in the marketplace, right? So Solera, as an example, I'll use Solera and Beanstalk as an example. And this is not, they're not the only two. Many of these organizations have extended beyond their core offering because they have to, because their clients are saying, I can't have multiple digital front doors. I can't have non-integrated activities. I can't have you just bring me your own ecosystem, and then I still got to deal with everything else, and they're not connected really well. I need to have one pathway to my employees to enroll, engage, and get really precision health management, right, to my employee base. So Solera, as an example, launched their Halo product, which is basically a companion product outside of its core condition areas in order to support independently purchased digital health solutions from self-insured employers that Solera doesn't manage. So Solera's got, 40 partners, whatever, 9 condition areas. Hey, you become a Solera client. Most of Solera's clients, for instance, are more Blue Cross Blue Shield plans than anything else. But hey, you're installed there. We've got a suite of services that we vetted like other people as well. And we'll layer on top of that our Halo platform, which helps to engage, enroll, and is a light way of saying we're supporting the rest of your work as we come on board and integrate. And Beanstalk's a great example of that as well. They do a similar thing in exactly their go-to-market offering, where they're becoming the single digital front door to really maximize benefit utilization in the right way, not just through their own ecosystem that they bring, but through the ecosystem that the employer already has. And I think that is a mandate of where this market is going in one form or fashion. There will be a single integrated front door. It's the only way health consumers are going to be able to really maximize the value of what's available.
So another way of looking at these solution aggregators is that employers are already contracting with 30 or 60 vendors for all of the different benefits that they have for employees. And then they have had to do, in sort of like in the HR department, an internal sneaker net to connect all of them. And that's not working, and they don't want to do that. So, but if they contract with a solution aggregator, then that solution aggregator has done the work to maybe do single sign-on or single billing or analytics across every company in its marketplace. And so they start and guaranteeing the IT security of employee information if they enter it into the system. And it used to be the HR department having to do all this work, but if they just choose one of the solution aggregators and then buy products through them, they can get this kind of meta functionality that rests on top of the underlying product functionality from the solution aggregators. And that's real work solution aggregators have to do and real value they're passing on to the employers. Well, so let's say you were a point solution. Let's say you're a great point solution, and you raised money. You raised $15 million, and a certain portion of that was allocated for sales and commercial. And then you're sitting down and you're saying, how much do I spend on another sales rep who's going to call on progressive large employers versus how much am I going to spend on business development people who are going to go out and seek to partner with Quantum Health, Collective Health, Virgin Pulse, all the other ones. And then should I try to be like the best friend of one solution aggregator? Like maybe United is my solution aggregator, for example, Optum is, or maybe Accolade is. Or should I seek to partner and be in the marketplace of all of them, even though this is a big project? It would be a big project to be in 5 solution aggregator marketplaces and support all that and do a good job doing that. So what would be the strategy of that point solution that has the money to pursue this? Should they go after all of them or none of them and try to sell direct?
$1 billion question, and the question that every investor should ask a digital health solutions provider, and that every digital health solutions provider better have a damn good answer. At the end of the day, there's no winner take all approach here. And I'm going to go back to the PBM formulary model just to try to give a picture of a corollary of this emerging market in digital health solutions and intermediaries that I'm calling aggregators, right? And I'm going to go back to how the PBM industry developed and how much control PBMs have had over time of drug utilization. And what that really means is that maybe your audience is familiar with national formularies or national preferred formularies for drugs. And maybe your audience is familiar with things like how many covered lives, like when Express Scripts or CVS Caremark says, I have 100 million Americans, right, that we provide the pharmacy services for, pharmacy benefit management services for employers and health plans, et cetera. And then you ask the question, how many of those lives are really controlled? Like the decisions that you make for your formulary, like the drug selection, here are my preferred ones, here are the ones that I don't prefer. How many of them and how much of a real impact does that have, right? And these organizations, first, the development of national formularies, happened a while ago, and then the adoption of it and the supporting business model, and I'll call that carrot and stick, meaning PBMs sell to employers. There are better pricing for health plans and employers that utilize the national formulary than those that customize, right? Because the PBMs are utilizing their volume to negotiate rebates with the pharma companies. Much like the aggregators can do the same thing with digital health providers, but the only way they could really use that leverage is if they were delivering digital health providers kind of uniform access, right? You're going to get 50 clients, right, within the first year after you sign on. But none of the aggregators can lay claim to that. No digital health solution provider can ever expect to have something handed to them as a result of the relationship. So there will always be a degree of, we call it pull through in the pharmaceutical industry. I'm still going to call it pull through in the digital health industry. This is about pulling through that parent level aggregator agreement, like drug companies pull through PBM agreements down to health plans, down to employers, through doctor prescriptions and into revenue generation. It's the exact same thing that happens here. So it's not magical. It still requires work. There will still need to be BD teams and sales forces that are focused on the employer and or health insurance segment, which are the clients of the aggregators to begin with. And if a company wants to choose to believe that somehow signing a deal with one of the aggregators is going to materialize into an IPO, I would caution them that might not be the case. Even if you sign deals with every aggregator, I would caution you that might not be the case. On the other hand, if you take a very coordinated, very intentional, and if you're lucky enough to work with an aggregator in an integrated fashion, which not all aggregators work the same way with their ecosystem partners, some are extraordinarily hands-off. You will never understand the client base. You won't know who they are. You'll have to do all your own research. You'll never have a joint presentation. You'll never know if someone's actually selling you or not, or selling your competitor more than you or not. This happens all the time and has for decades in the pharma industry. It's what's happening today and will continue to happen. But it doesn't happen the same way everywhere. That's really the point. Got to be intentional, got to do your diligence. There's going to have to be some degree of investment to mine the store here. These are good opportunities, but they need to be diligenced well and supported in the right way. And they're different, each one.
Thanks. So I'm going to cover some comments here. Katie says, employers want one firm to help manage all the solutions. They want pay for performance, and they need consolidated reporting to show the value to their leadership. So that's great, Katie. I totally agree. And that's why we're seeing the aggregators be successful in opening marketplaces and having point solutions do the work to be in the marketplace. And then another, Steve mentions the navigation model will be subsumed by the carriers. That's interesting. The carriers will not tolerate being disintermediated. So already you've got Optum building its own walled garden in this area and taking on the role of navigation. But the other carriers won't like the fact that there's independent navigation companies that are powerful and can promise employers that they can both drive utilization on the part of employees and steer them toward high value care. So let's see. Another remark was, I think it was Edward commented that you need to be both. So going back to our scenario of the point solution that raises $15 million, have to figure out its commercial strategy. It's not enough to say hire sales employees and go direct, and it's not enough to say sell through the aggregators. You have to do both. So
100%.
Now, another scenario here is that I have a thesis that goes like this. So it is that we've seen over the last, call it 6-7 years, the creation of the solution aggregators who will often have a marketplace. And in that marketplace is many point solutions. And that they did this because initially we were in a low interest rate environment. And in that low interest rate environment, the points that there could be great entry of point solutions into the marketplace. They could all raise money and they could all be at high private market valuations. And so along came the early solution aggregators and consolidators, and they said, I think I want to build my own solutions, but I can't build them fast enough. And I want to buy point solutions, but they won't sell to me for less than 20 times forward revenue, which is too high. But buyers are saying they want to buy suites, complete suites with meta functionality through me. How do I do that today? How do I do it right now? And the answer was to create marketplaces and to partner with point solutions in those marketplaces, and then to resell on their own paper to the buyers, to the employers, these solutions. So that's how they did it in a low interest rate environment. But we've just seen a sort of a interest rate regime change, and we're now in a high interest rate environment. So those point solution companies, they're not trading at such a high valuation anymore, and they can't easily go out and raise their next round of funding at a high valuation, a large round of funding at a high valuation. They can't do that as much anymore. Some of them are running out of money. And so it seems to me that this is when the solution aggregators turn into consolidators again. And then and in a sense, they're going to have the best data in the world about their marketplace companies. And they'll know whether they want to buy a marketplace company, and they'll buy it for less today than they would have bought it for 2 years ago when interest rates were low. And there's a differential in access to capital. A large solution aggregator can still access capital. A small point solution has much worse access to capital today than it did 2 or 3 years ago. So you'll see the solution aggregators will start to buy their favorite marketplace companies. And that's really bad news. So it means a couple of things. First of all, it means that if you're a point solution company, you think you're engaging in a marketplace strategy or an aggregator strategy. You're actually engaging in an acquisition strategy. You're going to be acquired by one of these solution aggregators down the road. And then secondly, if a solution aggregator has several wellness companies, let's say, in its marketplace, and then it buys one of those, well, that's really bad news for the remaining wellness companies in that aggregator, because they have one less sandbox to play in, and that solution aggregator is going to use its clout with customers to steer them toward the wellness company that it bought and its solutions. So I see this playing out in a kind of a Highlander type scenario. There can be only one where the solution aggregators are going to start buying point solutions with a preference for the ones that were in their marketplaces, which is going to be great for the ones they buy and terrible for the companies in the marketplaces that they don't buy. Is that so? That seems like a likely scenario to play out over the next few years. And what might help that is we're seeing record high stock market prices. So that means that those companies here that are public are going to get a second currency with a high valuation in it to make these acquisitions. So Accolade's public and Teladoc's public and that sort of thing. And I also think that if we see if we see funding come back into the sector, funding's been tight recently. So if we see funding come back into the sector, that will also power this as well. You might see companies go public. If the IPO window opens, you could see more consolidators go public, and you could see private equity companies become more aggressive about funding roll-ups in the sector as well. So any thoughts about how this plays out from a consolidation perspective?
Yeah, I mean, Steve, I guess I would bet that we'll see at least one. So I can't dismiss the thesis. I bet we'll see at least one. On the other hand, I don't know. I mean, some of the leaders in these ecosystems are 4 to 5x higher valuation than their potential acquirers. So let's not forget, Teladoc's not even a $2 billion company anymore. Amwell's at $125 million. And you got Sword and Hinge and Omada that are $4 billion companies. So, I don't know. Yes, we're not talking maybe about the big boys. Maybe we're talking about smaller up and comers that have a tremendous value proposition and are cheap now. Of course, there's going to be opportunities there. So I don't dismiss that at all. I agree that we're going to see it, and we already have this today. So ShareCare, for instance, has its own in-house DTX products, right? We even have aggregators that have as a part of their ecosystem a competitive aggregator's own product. So Solera, for instance, has Personified Health's obesity management program in their condition set. So it's not as if they don't play in each other's sandboxes, and it's not as if they don't have their own independent offerings that already exist today. And I agree with you, Steve, we're likely to see some transactions happen. I'm not ready to bet on the whole market going that direction. I'm not sure. I don't think that's the secret sauce that these folks are looking at. I think what these folks are looking at is not the IP on the actual tool, but it's the IP, it's the AI, it's the secret sauce engine of enrollment, engagement, eligibility, reporting. It's the matching, it's those types of things, the navigation things, and not really the clinically driven translational medicine aspect of things that some of these organizations have had to invest in clinical and medical activities in a more substantial way. I think we'll see it, but I can't wait to see it. Can't wait to see what happens.
Great. And any final questions from our audience for Mike? And so Patricia notes that the marketplace does not guarantee quality or integration of the individual point solutions. Is there any way to identify point solutions that bring value and be able to look for signs of true integration? The hype seems to be louder than customer satisfaction ratings. Yeah, so this is a good point. There was the Peterson Institute and the Validation Institute, which is here in Boston, and others are trying to rate there's many solutions for diabetes, many for hypertension, many for wellness. They're trying to rate these solutions. So Mike, any thoughts on how to identify point solutions that really do what they say?
Yeah, integration, I just don't think is a really transparent thing that one could evaluate, right? That's going to be between the parties, right? Based on the tech stack, based on the backbone, et cetera. But no doubt that's a key theme. And open source, public APIs, integration capabilities. With many of these aggregators, like it's table stakes. Like as a digital health solution, if you're not going to integrate into their platform, you will not be part of their ecosystem. That was a serious phone call. That must have been dinner time. So you might have heard that's table stakes for some of these aggregators. If you don't integrate, you can't be a part of the ecosystem anyway. As it relates to kind of clinical or medical diligence, again, that's all over the board too. Every one of these aggregators will have a different degree, a different sensitivity to kind of clinical or medical merit. or you don't even have to use clinical or medical. Some of the organizations will say, show me proof of impact. And that's a pretty generic statement, right? It doesn't say, I need 2 randomized controlled trials that show efficacy in a certain population. It's just saying, demonstrate some impact for me. So the bar for quote effectiveness or in the solution, then ROI, meaning how effective to how much the cost is, varies everywhere. But I would say that the integration piece is increasingly more important across every one of these distributors, because the distributor, the aggregator themselves, their value proposition is about bringing something more seamless and appealing, right, to their client. So without the integration, there is no value proposition for the navigator, right, to be able to report, to be able to engage, et cetera.
Great, thank you. So with that, we'll wind it up. Thank you so much to all of our our large engaged audience. Really appreciate all of your questions. Thank you, Mike, very much for joining us.
It's my pleasure. Thank you, Steve. See you again, and thanks to your audience.
So you've been listening to Digital Health Investor Talk. I'm your host, Steve Wardell, our guest, Michael Pace. We're publishing this show as an episode of the Digital Health Investor Talk show. You can subscribe on Apple and Spotify. Don't forget to rate us. And our next show is on Wednesday, June 26th, on the topic of what adds sizzle to a fundraise or acquisition, with our guest, AJ Loyacono, the CEO of RX Capital. And for our Boston area members, we have a health innovation night on Thursday, June 13th from 5:30 to 8:30 at the Liberty Hotel in downtown Boston, with our special guest visitor, Mike Pace, again that night. So hope to see you there. Thank you all so much. Bye-bye.